I want to try and break down exactly what it means to invest your money, why people do it instead of leaving their money safely in the bank, and the not-so-secret sauce to building wealth over time. So we have a lot of ground to cover in a short-ish video, so let's get to it. Hi and welcome back to the channel. My name is Pete Matthew and I am a chartered financial planner based here in the UK. And since 2010, I've been creating content to give you everything you need to know and everything you need to do to secure your financial future. Now, there are only 3 uses of money. You can spend it on things that you need or want right now, from food to holidays to Netflix subscriptions. You can give it away to people or causes that you care about, or you can invest it so that you can spend it later. And that's the main reason people invest. They want to grow their money over time so that they can spend more of it later. And we're hearing a lot about inflation right now. Inflation is the phenomenon that makes things generally more expensive over time. So if you're going to spend money in the future, you're going to need more of it. So now we know why people invest. What does it actually mean to invest money for the future? Let me try and put this as simply as possible. Investing is exchanging your cash for assets which increase in value or produce an income, or both. I'll say that again because it's important. Investing is exchanging your cash for assets which increase in value or produce an income, or both. So let's break that down. Now, when I talk about exchanging cash for assets, I'm not usually talking about hard physical cash like this. Most of us keep our cash in the bank. We can log into our accounts or go to the ATM and check our balance, and it'll tell us how much money we have. Let's say that balance is £1,000. Now, if we're lucky, the bank will pay us a little bit of interest for the privilege of us letting them keep our money safe. But it's not going to be very much interest, and if it's a current account, it'll be no interest at all, probably. So our £1,000 is going to stay at £1,000, except that its value is going to be reduced by inflation over time. That £1,000 will buy us less and less as time goes on. Cash is only any good for spending on stuff now in the short term. So we ought not to keep too much of it, really only enough to cover our day-to-day expenditure and maybe anything we're saving up for in the near future, like Christmas or next summer's holiday. Any other money that we have that we don't need in the short term should be invested. And that means exchanging our cash for assets. Now, there are loads of different kinds of assets, but here are the main types that people invest in. First, we've got property. People buy houses as investments. They will rent them out to long-term tenants or maybe do holiday lets or Airbnb. Then we've got shares or equities. A share is a tiny, tiny slice of a company. So if you own a share, you own a really very small part of the company whose name is on the share certificate. And owners of any company get some rights. They get to share in the profits of the company, and they get to vote on company affairs, like deciding who's on the board. Then you've got bonds, and bonds are just confusing things because the word bond means loads of different things in finance. But in this context, though, it simply means a loan, like an IOU, usually to a company or a government. And in return for you, the investor, lending money to, say, Marks and Spencer's, they will pay you interest and promise to give you your money back at a fixed point in time. Then we've got commodities, and these are the things that we as human beings consume, ranging from metals like gold, silver, platinum and others, to so-called soft commodities like wheat and sugar, to oil and gas, hot topic at the minute. There are other kinds of assets too, but each of these things that you can invest in seeks to achieve one or both of the goals for any investment: to increase in value or to produce an income. How are you doing so far? Are you staying with me? That's good, we're doing really well. If this is useful so far, please do me a favor, hit the like button. Subscribe to the channel if you're not already. It really does help me out and keeps the channel visible and takes you no time at all, so thank you. Okay, so let's talk about increasing in value, and all assets have the potential to increase in value, and the idea is simple enough. You buy £100 worth of shares in a company, they increase in value, so they're now worth £200, and you've doubled your money. You are an investing genius. Well done. But how does that happen? Well, there are 2 main factors which affect the value of any asset. The first is supply and demand. So let's use property as our example here. Let's say there's a really nice village or part of the town near where you live. If there is only one house for sale there, loads of people are going to want to buy it. And that means that the people selling will be able to sell for a higher price because demand is high and supply is low. There's only one house on the market. But if, on the other hand, there are 10 houses on the same street, then it's the buyers who get to set the price a little bit because they can choose which of the houses they like. Maybe haggle a bit more. After all, if you won't sell to them, then they can go next door and buy that house instead. And so the sellers might be tempted to reduce prices so that they can be the ones to sell. So that's supply and demand. And apart from that, the other factor affecting the price or value of an asset is sentiment, how people feel about that asset. So let's use shares as an example this time. If you buy shares in a company, and that company does really well, making loads of profit, and it's really well managed, and the outlook is good, then investors will perceive that this is a good investment. More people will want to buy, and the price will go up. If, on the other hand, the company issues a profit warning, or has like a really high-profile product recall, then investors might think that there is trouble ahead and sell their shares, driving the price down. So you can see how sentiment and supply and demand are linked. Better sentiment equals more buyers equals rising prices. Worse sentiment equals more sellers, or fewer buyers, and that leads to falling prices. Now obviously the hope of any investment is that it will rise in value over time, but you're already getting the idea that this isn't always the case, which I'll touch on just before the end of this video in just a minute. But the other reason to invest, apart from the value of your investment going up, is to produce an income. So if you own property and it's rented out, you will receive that rent as an income. If you own shares and the companies that you invest in make a profit, you might get a share of that profit called a dividend. If you own bonds, then you'll be paid interest by the borrowers of those bonds. Now, commodities are the exception here because they don't generally produce an income. I mean, a bar of gold doesn't grow little extra gold flakes and throw them off. But you can either spend the income that your assets produce, and you might do that if you're retired and you want to be spending and enjoying your money rather than growing it for the future. But the real magic of investing comes from using that income produced by your investments to buy more of the asset, more of the investments in a magic process called compounding. And compounding, or you might hear it called compound interest, is one of the most powerful forces that anyone can harness to build wealth over time. If you use the income produced by your assets to buy more of that asset, you'll have more income next time around. Keep repeating this process and the size of your investment can really start to increase hugely over time. I'm going to do another video putting some numbers on this for you, so stay tuned for that. But finally, a quick word about risk. And we've touched on the fact that investments don't always increase in value. They can also go down. And you need to be prepared for that if you're going to be an investor. Really importantly though, just because the value of your asset has gone down doesn't mean that you've actually lost any money. Not yet anyway. Because you only lose money, or gain it for that matter, when you sell the asset, converting the asset back into cash that you can spend. And that's why we don't invest money that we're going to need to spend in the short term. We just don't want to be forced to sell our assets, our investments, at a loss. Risk is a necessary factor for investors to understand, and I did a video on that a little while ago, so I'll put a link to that up here and in the description, but I'll probably revisit it in a new video soon. But without the risk of your assets going down in value, there is no possibility of them going up in value. You literally can't have one without the other. Anybody who promises you that is probably a charlatan, so be wary. So we need to get comfortable with the idea of risk if we're going to make money, if we're going to build wealth over time. So there we have investing in a kind of a nutshell. It's all about putting your cash to use by exchanging it for assets that increase in value, produce an income, or ideally, both. Make sense? Yes, there is a lot more to it than just what we've talked about today, but you can check out the channel for more videos on how money works. And if you've got any questions, then leave them in the comments section below, and I'll do my very best to answer them for you. Thank you so much for watching this one, and I'll see you in the next video.